one of the lessons, sort of stepping back for a moment and looking at like the sort of electronification of finance and capital markets, which has been going on since, really since the 1970s, the 80s. It's, the lesson there has been that kind of as you move through these asset classes, equities, derivatives, fixed income, and eventually perhaps alternative investments as well, that the sort of electronification drives transparency, it drives efficiency in the markets, and it also creates, opportunities effectively for investors to become more informed and for businesses to become more efficient, right? Like data unlocks insights into portfolio performance, into risk exposure, into investment trends. It also can drive operational efficiencies, and I think all of that is like on balance, like good for society really, as well as good for obviously these investments specifically and these asset classes. I think that for alternative investments, these increases in efficiency and these benefits and insights don't necessarily come free. There is technology and tooling that obviously has to continue to be built out. There's also, for alternative investments specifically, you have a world where there's a wide range of kind of activities and complexity, and there's not really a standardized format, data formats across that. There's as compared to like equities, for example, it's much more opaque kind of segment of the market, and I think that that poses its own challenges, as we kind of look at the task of wrangling these mountains of data that are becoming accessible, and learning how to tap into that and derive value from that. And I think that that'll be one of the kind of differentiating factors over the next decade for partnerships, is like how well can they leverage these data-driven insights that are becoming available as the capabilities of machine learning and natural language processing get leveraged to help with these extraction tasks.